Now, what are derivatives actually used for? Well, they're actually frequently used by asset managers. Generally, of course, there's those three main uses for derivatives, which is hedging, speculation, and arbitrage. And asset managers, such as hedge funds, can use them for all three purposes because they aren't subject to the fairly heavy regulation on trades that could be made by, let's say, mutual funds. Mutual funds can essentially not use very much leverage. They can, for example, go short. They have to have a disclosure of what the investment policy is. Their shares are redeemable. In other words, investors can pull their capital quickly and easily, whereas hedge funds pretty much don't have to follow any of those. And that means that they can engage in market-neutral long-short strategies. They can make arbitrage trades that would probably also require taking both a long and a short position in some offsetting assets. They can invest in distressed securities. And importantly, they can be short volatility. Now, being short volatility can be explicit in the sense of simply selling options, or implicit, where you have a long-short position, perhaps on your long highly liquid securities and your short liquid securities with similar payoffs. And the reason that this might actually be a short volatility position was found out by the managers of long-term capital management when they took this type of position in bonds and found out that when the market became more volatile, people rushed to the more liquid safe assets, driving up the price of their short leg, driving down the price of their long leg, and actually leading to the collapse of that company. But selling volatility short still remains popular. And on top of that, of course, there are simply sort of open trades in options, buying options, as we see here by SoftBank, where SoftBank at this time fell in the sort of classification. Is it an asset manager? Is it a private equity firm? Is it a hedge fund? Is perhaps not clear. But essentially what they did is they just bought a large amount of call options on tech stocks, which interestingly led to a feedback loop where then market makers would have to hedge those sales of call options to SoftBank by buying the underlying asset. We'll talk about how to hedge option positions later, which would actually create a profitable feedback loop for SoftBank, at least for a while, in that buying more and more call options leads to an increase in the price of the underlying asset. But as I was saying, the essentially three reasons one would trade derivatives are hedging, speculation, and arbitrage, and asset managers really trade derivatives for all three of these reasons. But when a trader should actually be using derivatives for hedging or arbitrage and in a way goes off script to instead use derivatives to simply speculate, that can lead to unexpected and often disastrous results. A classic example of this is what happened at Societe Generale, where a rogue trader, in other words, someone who has gone off script in terms of what they were supposed to be doing, essentially entered fictitious hedging trades into bets on index futures. So if they were, let's say, long some position in a European or otherwise index future, they would enter a fake trade that seemed like they were offsetting short perhaps that same index or something that was correlated with it to essentially disguise the true size of the directional bet they were taking, where they were really just only long or short the futures. And for a while, this actually worked really well, where Jerome Kerviel, this rogue trader, made 1.5 billion in profits. But eventually, since this actually wasn't a hedge trade, it was just a directional bet, eventually it went wrong, losing the firm about $5 billion. So this is another sort of illustration of how powerful derivatives are, in that much more so than in trading in the underlying asset, it's possible to incur truly tremendous losses, as well as potentially to earn truly tremendous gains. But this is why institutions generally have fairly tight risk management policies, and why violating those policies, as in this example, can lead to pretty disastrous results. So let's look at an example of how you would hedge using derivatives. Let's say that we have a US company, but they will need to make a payment in pounds for imports from Britain in 3 months' time. And of course, if what they want to do is they're going to need to pay somebody 10 million pounds, how would you hedge this with a forward contract? Well, it means that you need to get your hands on 10 million pounds. How do you lock in the price of 10 million pounds right now? Well, you would go long a forward to buy 10 million pounds. And I would lock in a dollar to pound exchange rate, which would ensure then that you wouldn't have to worry about what the price of pounds in dollars was 3 months from now, effectively protecting you from exchange rate risk. Another example would be, let's say that you have 1,000 shares of a certain stock, and they're currently worth 28 per share. And what you want to do is you want to hedge against potential losses in this portfolio by buying a put option. And you do this for the next 2 months. So you buy a 2-month put option with a strike price of $27.50. The premium that you would pay for this right to sell your shares to somebody else for $27.50, effectively locking in a price floor for your shares of $27.50, would cost you $1 per share. And you can then make this hedge by essentially buying 10 option contracts, because remember, each option contract is for 100 shares. So you buy 10 of them, you are then fully hedged for that 1,000 share portfolio. Now, what would the payoff to this portfolio look like with this hedge relative to without it? Well, of course, if we don't have the hedge on, then the value of each share would just rise or fall with the spot price. And so with 1,000 shares in our portfolio, they would go anywhere from their current level of 28,000 total value of the portfolio. For every dollar per in price per share that the price would increase by, we would gain $1,000 in portfolio value. And for every dollar the price per share would fall by, we would lose $1,000 in portfolio value. Now, if we had this hedge on, if we had bought these put options, we would have still gains, of course, if the shares appreciated, but we would always be off by the difference of the premium that we paid, which was, remember, each option cost $1 per share. We bought 1,000 options to cover our 1,000 shares over 10 contracts at 100 each. So that means that we are now out $1,000 that we have paid for this insurance. So this is why once we have hedged, our value of shares is actually a little bit lower on the upside than it is without hedging, because we've given up $1,000 in option premium no matter what. Now, what has that $1,000 bought us on the downside? Well, it has locked in this price floor of $27.50 per share. But of course, then once we take into account the value of the premium that we paid, really the net payoff we would have if prices did fall, the lowest our portfolio could fall to would be $2,650, or sorry, $26,500. Why is that? Well, remember, because if we exercise our option, yes, we get $27.50, so our portfolio could be worth at minimum $27.50 per share, or if we have 1,000 shares, that would be $27,500. But the problem is that we did pay that $1,000 in premium to put in this floor. So really, the net value of our portfolio, after we pay that, well, including the fact that we've paid, because we've already paid this premium at the beginning of putting on this position, the net value of the portfolio would be $26,500. Now, what about speculation? We've talked about hedging. How do you use options to speculate? Or, well, other derivatives also. But let's specifically think about options. Let's say that we have $2,000 to invest, and we have a view that a stock will increase in price for at some point over the next 2 months. The current price of the stock is 20, and a 2-month call option trades at $1 and has a strike of $22.50. What are the two things that we could do? Well, if all we know is the price of two assets, we can either trade the underlying or trade the option. Let's just see what we could make happen with both of these. At first, with the underlying, well, how much of the underlying stock could we buy? We think it's going to appreciate, so we of course want to buy it. Its price per share is 20. We have 2,000 to spend, so that means that we could buy 100 shares, right? So what would happen, let's say our view is that the price is going to go to 25 in the next 2 months. Well, that would mean that if we own 100 shares, we bought them for 20. Our profit, which we'll denote by the letter pi, is going to be 100 times what our final value of the portfolio is, which is 100 times 25, 2,500, minus our initial value of the portfolio. We had 100 shares that we bought for 20, so that's 2,000. So our profit is $500, which is definitely not bad, right? We've effectively earned a 25% return. But what would happen if we traded the option instead? Well, if each option costs $1, remember the option contract covers 100 shares, that would mean that we could buy one contract for $100. How many contracts could we actually buy in total? Well, if we have 2,000 to spend, we could buy 20 option contracts, right? 20 contracts, each of them for 100 shares of stock. In other words, a total of 2,000 options on each on one share of this stock. Now, if the price goes to 25 again, what is the payoff to each of these options? Well, remember, we get to buy at $22.50 because that's what this call option gives us the right to do. If the price is 25, the payoff per option is 25 minus $22.50, or $2.50. But now we own 2,000 of these options. So we've made $2.50 per each of them. So that means that our profit is $2.50 per option times 2,000 options, $5,000. So we've literally made tenfold the profit that we could by trading the underlying asset. That's sort of what is exciting about options. They magnify your gains as well as, of course, your losses. By the way, you might ask, wait, didn't we just spend all of our money on options? How could we even exercise these options? How could we buy the stock worth $25 for $22.50 if we don't have the capital to buy 2,000 shares at $22.50 each? Well, you could simply sell the options to somebody else, and you would probably get something very close to this intrinsic value of the option for doing so, because that's how much somebody else could earn by exercising. Now, what about the last category, arbitrage? This is perhaps the most complex one because it requires thinking both in terms of a short position and a long position usually. So let's look at sort of a simple example without derivatives first, just sort of to get a flavor of how arbitrage works, and then we'll think about it in terms of derivatives. So let's say we just are dealing with a stock, and the price of the stock is £100 in London and $152 in New York. And the current exchange rate is $1.55 per pound. What is the arbitrage trade that you would make? Well, first of all, is there one? It seems like there should be, right? Because if you translate this £100 into dollars using this exchange rate, it seems like this stock is worth $155 in London. Now there's transaction cost potentially, so maybe this isn't quite what we expect it to be, but let's say we'll ignore transaction cost for the time being. If we use this exchange rate to convert pounds to dollars, we can buy the same stock for $155 as we could for $152 in London relative to New York. So it seems like there's a mispricing. How do we convert a mispricing to arbitrage? Well, the basic idea in arbitrage is that you're going to buy low and you're going to sell high, same as in all investing. It's just that here you can actually do it. What's the thing that we want to buy then? What's the cheap version of the same security? Because remember, the point of arbitrage is we can essentially lock in a riskless profit by essentially not having anything at risk. So if we have the same security that we can buy at a low price and then sell at a high price, we no longer own anything, we don't have anything at risk. Hopefully we just make a profit on the difference. So we'd want to buy at the low price, in other words, the $152 in New York. How do we sell high? Well, if indeed this exchange rate is true, then it looks like the stock is overpriced in London, if it's the same stock. So that means that what we could do is we could short a share of that stock in London. And then we would actually be in a riskless position, right? We would own one share of stock from buying it in New York. We would have spent $152. That would give us plus one share. Our short sale in London would give us an inflow of $155 per share, assuming we're immediately able to convert that £100 into dollars. And of course that would leave us with minus one share, because now we owe a share to somebody. But if we put these into one portfolio, we just sort of add up our position in London and New York. What that gives us is we now own net 0 shares, because we can return our borrowing at any time, and we should probably do it right away, really, so we can just keep doing this again. But we have made positive $3. And there's no more risk because we can immediately return our borrowing of that one share that we sold short in London. So this is an example of an arbitrage trade without any derivatives. So now let's actually think about the additional complexity, and there is substantial, that would be introduced into this with derivatives. So let's think about futures prices and how they might result in arbitrage opportunities. And this will sort of give us our first insight into how derivatives should be priced if there are no arbitrage opportunities, or in other words, once arbitrageurs have worked out any possible mispricings, what the fair price of derivatives would be. Let's say that the spot price of gold is 1,100 per ounce, and we see that a 1-year future price of gold is 1,200 per ounce. And we see that the 1-year interest rate is 2% per year. We'll see why that matters in just a little bit. And let's say that there is no income or storage cost for gold. Realistically, the no income part makes a lot of sense. The no storage, well, you do have to pay somebody to look after your gold. But let's ignore that for the time being. Is this an arbitrage opportunity? In other words, how do we know whether we could make a riskless trade at a profit if we know the future price is 1,200? That seems high, but how do we know whether it actually is or not? Let's consider an alternative where pretty much everything is the same. The spot price of gold is the same. The interest rate is the same. The 1-year futures price is 1,050. Does it seem like that would lead us to an arbitrage opportunity? Well, again, we don't really know. 1,050 seems low, but how could we actually show whether there is or is not an arbitrage trade? Well, this is sort of where the idea of the forward or future price comes in. There's actually a simple relation that we can make between the spot price and the futures price, which is as follows. The spot price simply is compounded at the risk-free rate for the number of periods at which the rate is quoted per period. So if we're talking about a 1-year risk-free rate, then we just compound it for 1 period. So we'll make the assertion that the fair futures price for gold is just the spot compounded forward at 2% for 1 year. If we calculate that out, our spot 1100 compounded at 1.02 for 1 year, so we don't need to do anything with the exponent, is $1,122. Now, why would that be the no arbitrage future price of gold? Well, let's go back to our first case where we were thinking that what we could do if the price were actually 1,200. What riskless trade could we make to earn ourselves a profit right now, essentially meeting the definition of arbitrage? Well, if we're going to follow this idea of buy low, sell high, it looks like this futures price is too high. So let's sell it. Let's sell one futures contract. Remember, this obligates us to sell gold in a year's time for 1,200 notes. How can we make sure that we have that gold to sell? Well, what we can do is we can borrow $1,100 right now. And we can spend it to buy 1 ounce of gold, because that's how much we can buy 1 ounce of gold for right now, right? And then all we do is just wait for a year. In a year's time, we're going to fulfill our futures contract. We're going to sell that ounce of gold. So we're going to receive $1,200. And we can use that $1,200 to pay off our debt. Remember, we borrowed $1,100. Of course, in this time, this $1,100 has compounded interest at 2%. That actually would mean that loan is now worth $1,122. If you notice, that's the fair futures price we claimed. But that is how much we would pay back. And the profit that we would make, and of course this would be riskless profit because we locked in the price at which we would sell that ounce of gold. Our borrowing is risk-free. Really nothing can change the parameters of this trade. We have effectively guaranteed ourselves a payoff of $78 in a year's time. So to avoid riskless arbitrage, it looks like the forward price can't be more than the future value of a riskless loan of size equal to the spot price. So for now, we know that the future price has to be less than or equal to this effectively loan in the sum of the spot price compounded at the risk-free rate. Now, what if the futures price in the other scenario we considered, what if it was low, 1050? Well, again, the sort of key to thinking about arbitrage is buy low, sell high. This futures price seems low because, remember, again, we claim that the fair price is $11.22. So I guess we want to buy this. So we're going to buy the futures. Remember, this will obligate us to buy an ounce of gold in a year's time for $10.50. And what we're going to do is we're going to sell short 1 ounce of gold. So we're going to borrow that ounce of gold and we're going to sell it. Buy a future, sell short, 1 ounce. Now what are we going to do with the proceeds from the short sale? We're going to get 1,100 for that. So we're going to invest that 1,100. We're going to lend. The amount of money that we receive from the short sale, which of course is the spot price, $1,100. We're going to lend it at the risk-free rate because we certainly wouldn't want to lose this investment. And that means that in a year's time, what are we going to have? Well, we're going to receive from our investment in a risk-free bond, we're going to get 1122. There's that number again. And remember, we have the obligation now to buy an ounce of gold under our futures contract. So we're going to do that. With the futures price is specified, so we're going to pay $10.50. We're going to have $72 left over. We're going to technically now hold an ounce of gold, but remember, we sold short an ounce of gold, so we'll just give it back to whoever lent it to us. We have now no gold, and we have $72 in profit. So it seems like, to avoid riskless arbitrage, the forward price also can't be less than the future value of a riskless loan, compounded at the risk-free rate. So if it can't be more than that, and it can't be less than that, well, I guess it has to be equal to that. So that's sort of how we show that this indeed is the relation between futures price and spot price, using no arbitrage arguments. Let's just look at a couple more cases that'll sort of give us a bit more of a preview of additional complexities in derivatives. Let's say that we're dealing now with oil. We know what the spot price of oil is. We know what the future price of oil is in a year's time. We still have a risk-free rate, but now we also have a storage cost. Is there an arbitrage opportunity now? Well, how does a storage cost factor into this? Let's just sort of think about what we would do if we were operating under our old idea that, well, we're just going to compound our spot price and see what how that relates to the quoted future price. If the future price is too high, I mean, this price of 50 does seem fairly high, because in 1 year's time, 40 is surely not going to grow into 50 at a 2% rate. So we're probably going to want to conduct the first type of trade that we saw in the prior slides. We're going to want to sell the future. We're going to borrow some money. We're going to buy the underlying asset. We're going to hang on to it. And then eventually we're going to fulfill our obligation according to the futures contract to sell that barrel for $50. And that's sort of where the storage cost comes in. You can see that if we're going to hold on to this barrel, we're going to have to actually pay that 1% storage cost. So the adjustment to the future rate formula is going to be that not only are we going to be responsible for the financial cost, we're also going to be responsible for the storage cost. So we're going to take 1 plus R plus S to the T. And you'll see why this makes sense forthwith. But let's just see what that comes out to. Well, what is both R plus S? The risk-free rate is 2%, the storage cost is 1%, so this is 1.03. And 40 compounded at 3% for 1 year is 41.2. So if this is indeed the relation for a futures price. It does seem like the one we're observing is too high. So let's again do what we did just a little bit ago. We're going to sell the futures, obligating us to to sell a barrel of oil for $50 in a year's time. We're going to borrow $40. And we're going to buy a barrel of oil with it. Now we're going to hold on to that barrel for a year, and then we're going to sell it according to this futures contract, receiving $50 in exchange. What do we owe for the financing cost of having done so? We borrowed $40. We owe 2% interest on that. If you take 40 times 1.02, that is 40.8. That's the amount we're going to have to repay for the loan. But remember that not only were we responsible for repaying that loan with 2% interest, we also have to pay 1% for storage costs. So on top of that, we're going to take 40 times 0.01, and that's going to cost us 40 cents to store that one barrel. Of course, we're probably operating at bigger scale than that, but let's, for now, just treat it as a one barrel transaction. So we paid 40.8 to repay the loan, and we paid an additional 40 cents for storage. So that means that in total we paid 41.2. And that means that our profit then is 8.8. And you see that this 41.2 is exactly the futures price that we had conjectured to be the fair one. So we can again say that the futures price can't be higher than now the value of a riskless loan plus storage with the present value of the spot price. If it actually is above that, then we can make this sort of arbitrage trade, earning a riskless profit. What about the flip side of that? Let's say that oil is still at 40, but now the futures price is 35. Still 2% interest rate, still 1% storage cost. Is there an arbitrage opportunity? Well, again, we know from, or what we've conjectured from our prior claim, that the fair futures price is the interest rate plus the storage cost. 1.03 is what those two add up to. So that is 41.2. This futures price is lower than that. If we're going to do the arbitrage trade and we're going to think buy low, sell high, well, that means that we want to buy this futures. We want to go long, obligate us to buy a barrel of oil in a year's time for $35. Now, how can we make sure this is going to be a riskless trade for us? Well, what we can do is we can borrow and sell, in other words, short, one barrel of oil. What we're going to receive for that is, we're going to receive 40, because that's the spot price. That's what we'll sell it for right now. We can invest that at the risk-free rate. So in a year's time, we will receive 40.8. We computed that on the prior slide, which is just 40 compounded at 2% for 1 year. But on top of that, we can actually receive something else, potentially. Remember, we borrowed a barrel of oil from someone. They no longer have to store it. So we may very well be able to tell them, hey, since we're taking this barrel off your hands for now, we're storing it for you. We're going to give it back to you, we promise. Why don't you pay us that storage cost, which, remember, we worked out on the prior slide to be 40 cents. So we receive 40.8 from the short sale and investment at the risk-free rate, and we receive 40 cents for storing that barrel of oil. Now we'd better give it back, but we actually are certain of being able to do so because we have this long futures contract. We're going to buy it for $35, which of course means we have to pay $35. And that means that what we're going to make is the difference between this number, 41.2, and whatever the futures price actually is. We're going to get that barrel of oil. We're going to return it to the person who lent it to us. Now they'll be responsible for storing it again, but we stored it for them for some time. That's why we get that 40-cent rebate. And the net profit we make is the difference between 41.2 and 35 of $6.2. So we see again now that the futures price can't be lower than the spot price compounded at both the risk-free rate and the cost of storage for the number of periods. So this is sort of how we would extend the futures pricing formula to account for storage as well. So this is sort of an overview of derivatives, what their different types are, how we can actually calculate profit and loss on them, how we can use them for hedging and speculation and arbitrage, and sort of how we think about constructing arbitrage trades in derivatives. Thanks for listening.